Hello, future millionaires investors. Being the richest investor now with a net worth of $130.4 billion, we're delving into 6 of Warren Buffett's renowned rules of investing, as these principles have been integral to Buffett's investment philosophy and have offered valuable insights into achieving his long-term success in the investment world. These rules will transform your investment journey as a beginner or already an investor. There will be a bonus rule, so stay tuned to know it, as it's the foundation of your investing journey. 1. Invest in assets, not cash. Warren Buffett famously said, "The one thing I will tell you is the worst investment you can have is cash." Everybody is talking about cash being king and all that sort of thing. Cash is going to become worthless over time, which is true. As years pass, we have seen the devaluation of our money as it loses its purchasing power. So, when Warren Buffett talks about investing in assets rather than cash, he's highlighting the concept of opportunity cost. Holding on to cash may feel safe, but in reality, it's a losing proposition over the long term. Inflation erodes the purchasing power of cash, meaning that the same amount of money will buy fewer goods and services in the future. As cash sitting idle loses value due to inflation, investment in assets have the ability to grow and generate income that exceeds the rate of inflation, enabling you not only to preserve your wealth, but also grow it in the long run. If you would like to know the best assets Warren Buffett continuously advocates people to invest in, leave Assets by Buffett down in the comments section below, and I will for sure make that video next after this one. 2. Invest in valuable, productive assets. Buffett once said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This rule underscores the importance of focusing on quality when selecting investments. Not only that, it also reflects his belief in the power of compounding. When you invest in quality companies that have strong competitive advantages, consistent reliable earnings, and competent management teams, you're essentially harnessing the power of compounding to grow your wealth exponentially over time. These assets have intrinsic value that can withstand market fluctuations and deliver sustainable returns over time. By investing in quality companies, you're positioning yourself for long-term success and wealth accumulation. 3. Evaluate companies before investing. Buffett advises investors to conduct thorough research and analysis before committing capital to any investment venture and conducting due diligence in the investment process. He said this in one of his talks, "Risk comes from not knowing what you're doing." Before investing in any company, it's crucial to understand its company's financial statements, business model, industry dynamics, competitive position, growth prospects, and management team. By evaluating companies based on these fundamentals, which are the underlying drivers of a company's success or failure, investors can make more informed decisions and avoid costly mistakes. As he also said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." He encapsulates the importance of investing in quality companies with strong fundamentals, even if it means paying a slightly higher price. In the long run, the superior growth and stability of these companies will more than justify the premium paid for their shares. His approach to investing is grounded in diligent research and a deep understanding of the companies he invests in, which has been key to his success over the years. 4. Long-term perspective. Buffett's investment horizon is famously long-term, as he once said on his approach to investing, "Our favorite holding period is forever." This rule underscores the importance of patience and discipline in investing. Instead of succumbing to short-term market fluctuations or chasing quick profits, Buffett advocates for holding on to quality assets for the long haul. By maintaining a long-term perspective, investors can ride out temporary market volatility and benefit from the power of compounding. His own success is a testament to the effectiveness of this approach, as he has consistently held on to investments for decades, allowing them to grow and multiply manifold over time. So remember, in the game of investing, it's not about timing the market, but rather time in the market. 5. Don't waste opportunities and play big. Warren Buffett's advice to not waste opportunities and play big encourages investors to seize opportunities when they arise and allocate their capital wisely. While it's important to be cautious and selective in investing, it's equally crucial not to miss out on lucrative opportunities. Buffett is known for making bold moves when he's convinced of the merits of an investment, whether it's acquiring a company outright or allocating a significant portion of Berkshire Hathaway's portfolio to a particular stock. By investing boldly and allocating capital decisively, investors can maximize their potential for returns and accelerate their wealth-building journey. However, it's important to note that playing big doesn't mean being reckless. Buffett emphasizes the importance of thorough research and analysis before making any investment decision. So, while it's essential to seize opportunities, it's equally crucial to do so with prudence and diligence. 6. Be fearful when others are greedy, and greedy when others are fearful. In line with not wasting opportunities, he once said this in one of his interviews: "Be fearful when others are greedy and greedy when others are fearful," epitomizing the essence of contrarian investing. In essence, he meant that when the market is exuberant and everyone is buying, it's often a sign that prices are inflated, and it may be prudent to exercise caution. Conversely, when fear grips the market and prices plummet, it presents an opportunity to scoop up quality assets at bargain prices. Buffett's success is attributed, in part, to his ability to go against the crowd and capitalize on market inefficiencies. By maintaining a contrarian mindset and staying rational during periods of market euphoria or panic, you as an investor can capitalize on mispriced assets and generate superior returns over the long term. If you have reached this far, then this bonus rule will be of great impact on every rule we have discussed, and this is investing in yourself. Warren Buffett emphasizes that the most important investment you can make is in yourself. This rule shows the significance of continuous learning, personal development, and self-improvement in the journey towards financial success. Investing in yourself involves acquiring new skills, expanding your knowledge base, and honing your abilities to become a more effective investor and decision maker. Whether it's through formal education, reading books, attending seminars, or seeking mentorship, investing in yourself pays dividends that extend far beyond the financial realm. Buffett himself is a voracious reader who attributes much of his success to the knowledge and insights gained from books. By prioritizing self-improvement and lifelong learning, investors can enhance their capabilities, adapt to changing market conditions, and ultimately achieve their financial goals.